During the most recent New York session, silver declined by an additional 16%, while Asian markets were closed. The US dollar strengthened, margin requirements were raised, and stop-loss orders were triggered almost simultaneously. There was no new negative information, no evidence of collapsing demand, only a system operating precisely according to its internal design. If you are holding US dollars, foreign currencies, gold, or silver, the relevant question at this point is not, should I buy or sell, but rather whether you are responding emotionally or being drawn into a sequence of actions that the market itself is compelling you to execute. As the New York session entered its latter half, price action ceased to follow its customary rhythm. Slippage became more frequent, deeper, and increasingly compressed in time. This was not the type of decline associated with a market reassessing new information. It was the behavior of a system actively releasing accumulated internal stress. For those who observed March 2020 or the opening hours of 2008, the sensation is familiar. Price no longer seeks justification. It merely reflects velocity. During those moments, silver was not being sold in the conventional discretionary sense. Instead, it was mechanically pulled through predefined price levels where stop-loss orders had been placed days earlier. These orders possess no emotion, no conviction, and no tolerance for uncertainty. They operate under a single condition. Once the trigger price is reached, execution is mandatory. Once this process begins, market direction is no longer determined by analysis or interpretation, but by algorithms and margin mechanics. What distinguishes this session is not the magnitude of the 16% decline itself, but its timing and structural context. Asian markets were closed. There was no physical absorption from China, no stabilizing flow from industrial consumers. What remained was a Western market characterized by elevated leverage, reduced liquidity, and a defensive posture shaped by multiple prior sessions of volatility. Concurrently, the US dollar began to appreciate. Not dramatically, not disorderly, but decisively enough to alter the prevailing risk configuration. In such moments, the dollar ceases to function merely as a currency and instead reasserts its role as a liquidity anchor. When systemic risk perception rises, capital does not engage in extended deliberation. It migrates toward the asset offering the greatest immediacy of exit. This remains the structural role of the US dollar within the global financial system. This shift initiates an immediate chain reaction. Foreign currencies weaken. Dollar-denominated assets lose relative appeal to international buyers. And within a market already strained by leverage, this alone is sufficient to trigger an additional round of technically driven liquidation. This is the phase in which many retail participants sense that something is wrong when observing price charts, yet lack the framework to articulate precisely what is unfolding. Silver, due to its dual nature as both a defensive monetary asset and an industrial input, responds more violently than gold under these conditions. This is not because its strategic role is deteriorating, but because it occupies the intersection of multiple capital flows. In favorable environments, this characteristic accelerates upside participation. Under tightening financial conditions, however, the same characteristic makes silver the primary conduit through which pressure is released. A critical point frequently overlooked is that the most intense selling pressure occurred while China was absent from the market. This observation is essential for correctly characterizing the nature of the decline. Had this move reflected a genuine shift in physical demand or strategic stockpiling behavior, corresponding signals would have emerged from Asian trading venues. That did not occur. Instead, volatility peaked during hours dominated by Western leveraged positions operating without counterbalancing flows from the East. Viewed through historical precedent, this pattern is not novel. It emerges whenever markets accumulate excessive short-term positioning amid increasingly uncertain monetary policy conditions. When expectations shift, adjustment does not occur gradually. It occurs through abrupt dislocations that force the weakest positions to exit first. During such phases, price frequently overshoots reasonable valuation ranges, not because markets are irrational, but because mechanical processes temporarily take precedence over value considerations. Within this context, attempts to attribute the entire move to weakening industrial demand require recalibration. Corporations do not alter procurement strategies based on a single volatile session. Supply chains do not operate on intraday trading signals. A more realistic interpretation is short-term hesitation in the face of heightened volatility, an outcome fundamentally distinct from a breakdown in the long-term demand thesis. It is precisely this structural separation that renders comparisons between silver and past speculative manias incomplete. Such comparisons may appear valid when focusing exclusively on short-term trading behavior, where rapid price appreciation attracts speculative capital. At a deeper level, however, silver retains characteristics absent from purely speculative assets: sustained industrial utility, technological relevance, and a role within monetary defense frameworks. These two layers coexist, and it is their overlap that generates pronounced volatility. This channel, therefore, adopts a different analytical lens. Rather than asking, "Where will price go?" the focus shifts to identifying which mechanisms are currently governing market behavior. Once that framework is understood, individual price candles, headlines, and confident social media assertions lose their ability to dictate emotional responses. What becomes visible instead is the system's internal rhythm and one's position within it. If you are holding US dollars, you are positioned to benefit in the short term from global liquidity contraction. If you are holding foreign currencies, you are experiencing the pressure associated with shifting policy expectations. If you are holding gold or silver, you are observing the divergence between short-term transactional pricing and the long-term function of defensive assets. All of these dynamics are unfolding simultaneously within the same market moment. What makes this phase particularly tense is not a lack of information, but an excess of overlapping signals. Prices are declining sharply, yet foundational conditions have not demonstrably deteriorated. The dollar is strengthening, while policy direction remains contested. Market reactions are occurring at a speed exceeding the capacity for human interpretation. Within that gap, emotion readily assumes control. The analysis presented here is not intended to prescribe specific actions. Its purpose is to clarify how markets are operating across the US dollar, foreign exchange, gold, and silver during a period in which monetary and liquidity pressures are actively reshaping behavior. Once this structure is understood, precise prediction becomes unnecessary. Understanding why the present feels constrained is sufficient. Before proceeding, consider the following. In recent sessions, what have you been reacting to? Percentage changes on a screen? Headlines circulating on social platforms? Or the sensation of being drawn into an accelerating rhythm? Leave a comment. Those reflections help illuminate not only market behavior, but our own interaction with it. This is precisely why this decline matters more than a percentage figure. It does not determine whether silver is cheap or expensive. It reveals which mechanisms dominate behavior when monetary pressure intensifies. In such moments, the relevant question is not what price, but rather who is being forced to act, and who retains the capacity to wait. Placed within the broader context of monetary history, every policy transition reshapes the role of defensive assets. Gold and silver do not disappear during these cycles. They are recontextualized as instruments for preserving purchasing power when confidence in fiat systems is tested over time. And this is only the beginning. In the months ahead, as policy, geopolitics, and technology continue to intersect, new signals will emerge, not noisily, but clearly enough to reveal the trajectory of the next phase of the cycle. How do you believe these dynamics will influence the pricing of the US dollar, foreign currencies, gold, and silver going forward? Share your perspective. This is Money Cycles, where we examine the structural forces operating beneath surface-level market movements. What is unfolding is not a final answer, but a set of possibilities that merit serious reflection.